join our Telegram group to stay ahead on all news and investment opportunities in Singapore market. Good evening, everyone. Welcome back to InvestingNote. I'm Jay, and I'll be your host for tonight. Have you all ever wondered what it's like to dive into the Singapore market on the banking and the REITs industry in 2024? Well, we are lucky as tonight we are honored to invite Darren Chan and Glenn Thum from Phillip Capital to join us today to share with us more about the Singapore banking and REITs looking ahead for 2024. The floor is yours, Glenn and Darren.
Hey, thanks so much, Jay. Maybe I'll let Darren pull up the slides first before we start. Yep. So anyway, before while Darren is putting up the slides, I'll just give a short introduction of myself. Yep. So I'm with Phillip Securities Research, and I cover mainly the banking and finance sector. So the 3 local banks in Singapore, as well as SGX and another sort of banking core banking system software company called Silver Lake Axis, which is actually based in Malaysia. So some of you might be familiar with that company. But yeah, so I'll just let Darren maybe just give a short introduction of himself first before I move on.
Yeah, thanks, Glenn. Hi, everyone. I'm Darren. So I'm a research analyst together with Glenn in the same department, and I cover the property and REIT sector. Yeah, so yeah, that's basically it. So I'll hand over to Glenn. We can start the presentation.
Yep, thanks, Darren. Yep, so for today, we'll be looking at mainly the Singapore banking as well as the REIT sector and what has sort of happened in 2023 and as well as the outlook for the rest of the year in 2023 and looking ahead into the future, more short term into 2024. So just the next slide. Yep, so this is just our usual disclaimer. Yep, you can just read through it. Yep, so our content, the first portion would be looking at the sector trends. So this will be the Singapore banking and the REIT sectors, and just going through the main highlights of what happened in the sector as well as for the outlook. And then secondly, we'll be jumping into our stock picks. So just take note that this will be very directed at the banking sector as well as the REIT sector. And last but not least, we'll have a short Q&A session. So if you have any questions, you could just put it into the Q&A tab, and we'll try our best to go through them at the end of the session. Yep. So just firstly jumping the sector trends. Yep. So for the banks, we're looking at the interest rates, and the main highlight of this slide would be that the NIM growth or net interest margin growth has continued for the banks, the Singapore local banks, at least the 3 local banks. And if you look at the dark blue line here, that is the Fed funds rate. So all of us are keeping track of that quite closely. So it has been on this sort of never seen before climb since the start of sort of 2022. That all the way now it's still climbing, but it has sort of stagnated recently. And if you look at the light blue line here, that is the 3-month SORA. So that's the Singapore interest rates. And using that as sort of a base, we can see that is followed very closely to the Fed funds rates. Even historically, all the way back to 2010, it has sort of followed closely, but it has lagged a little. And we can see the lag being more apparent in the recent months, where while the Fed funds rates have shot past the Singapore interest rates, the Singapore interest rates have still continued to actually slowly increase. So it has not dipped at all, or maybe just a very slight dip, if you can see at somewhere in 2023 in this year. But it has continued at this like moderate single-digit basis points increase for most of this year. And going ahead, looking into the rest of the year as well as into next year, for the rest of the year, the market expectations are that they will remain high, and this will continue to remain high going into the first half of FY 2024, FY 24. And there will probably not be much cuts at all if in the first half of 2024. However, the market is expecting that some of the cuts might come in the second half of 24. So as we all know, the banks are very dependent on interest rates. And why is this so? It's because, just a very brief overview, is that they make a spread on this interest rate. So, they're able to charge a higher amount as what they're getting from these interest rates, and that's how they make their net interest margins. And we can see also the net interest margins have been sort of tagging along to the interest rates, both the Fed funds rates as well as the Singapore interest rates. And, but however, we can see that when we go into the rest of 2023 as well as into 2024, so we don't really, just to backtrack, we don't really have forecasts for the interest rates, but we do have a forecast for the net interest margins. We can see that we have forecasted it to decline slightly, and this is mainly due to the expectations that the interest rates will stagnate in the first half of 24 and for it to dip slightly going to the second half of 24. So if you look at the numbers here, it's just a brief overview of the average of the three local banks' NIMs. And in 2022, it was historic. It was a sort of a really historical rise. We had a plus 32 basis points, and this was mainly due to the rapid increase in the interest rates. For 2023, we are also expecting it to be a similar increase of 32 basis points. And this is mainly due to the continued increase in the interest rates. But however, in 2024, we see that there's a slight decline. And this is what I mentioned earlier, where there will be a stagnation of the interest rates and maybe even a dip in the second half of 24. Now, moving on to my next slide. Yep, I'll have a brief overview of the three banks' results, and I won't really go much into detail because I will speak more about each bank's results in the stocks pick sections later. So I'll just look at the two red boxes here. If you look at the first red box here, we can see this is the third quarter results, by the way, and it's comparing between the last quarter. So a lot of some people are maybe just being quite worried that, if the interest rates not increasing further, how won't this negatively affect the banks? Because their spread is not increasing. So previously they were able to earn more money because interest rates go up, they can charge more and then they can earn a higher spread. But if you look at the third quarter where the rates have sort of stagnated, you can still see that their NIMs have actually increased year on year. And this was comparing to in third quarter of 2022 when rates were increasing really fast. But rates have sort of stagnated now. But yet you can see, it's a 14 to 29 basis points increase in net interest margins. This means that the banks have sort of managed to further lower their funding costs, and as well as try to position their loans in a way where they can earn more money. And resultantly, we see that the net interest income has also risen quite significantly. It's mostly double digit, only with UOB having a 9%. So that's very close to the high single digit, and the other two banks are all double digits growth. So they have managed to maintain their net interest income growth by maintaining the growth in the net interest margins. And resultantly, we look at the PATMI as well. It has also risen quite significantly, for all three banks. Now, moving on to my next slide. Yep, so I think one of the reasons I would like to further explain on why the banks are able to maintain such a positive net interest margins growth, and maybe not what a lot of people are looking at, or it really falls under the radar for many investors, would be the current account or savings accounts. So this stands for CASA. And the banks, at least the local banks in Singapore, the three of them, they depend heavily on the CASA to sort of lower their funding costs, because this is where all their money comes from, where they can take the CASA and then they can loan it out to people who come in and want to take loans. So CASA, in Singapore, it's in the local banks, it will be like the DBS multiplier account or the UOB One account, or even the OCBC 360 account. So these accounts are, while it might look attractive on the outside, when you see that the promotions and all the adverts are going on, they say, oh, up to like 7% per annum interest you can earn. But this is not really the effective interest rates. If you look at the effective interest rates, it's way less than that. And there are a lot of criteria to hit. So you need to maybe credit your salary, have a minimum spend on your credit card, or multiple sort of things that you must reach to be able to get that that really high 7% yield where they say. So majority of these current account savings accounts are not paying that high. They're paying the base interest in Singapore, which is around like 0.05% per annum. So this is like, to the banks, it's as good as free money. It's just sitting there for them to use. So when we see what happened in, like, let's say 2021 to the middle of 2022, we can see that the CASA proportion rose really sharply. And this was mainly due to the low, at that period where the interest rates weren't very high and people were hoarding cash because they were worried about with COVID and whatnot. So they were putting money into the current account savings accounts. And this was beneficial to the banks where they had a record increase in their net interest margins as well as their net interest income because of this cash. But then on the flip side, where you look at the loans growth at the period was really high as well. So they were able to use that cash to further grow their loans. But what has happened after that period when the economy was starting to recover and we had a post-COVID recovery was that we started to see that money was coming out of this CASA. And this money was all going into higher sort of yielding instruments such as the fixed deposits or even going back into the market. And we can see that there was a very long continued decline. So each blue bar represents a month. And you can see that it was declining for almost a year. And we're both looking at the CASA proportion, which is a proportion over the deposits, as well as the total CASA. It has been going down. But however, the positive is that in the last couple of months, we have seen that the CASA proportion, as well as the CASA itself, has started to maintain at the current levels of around 19%. And this is very significant for the banks because the CASA, or the CASA ratio at least, it sort of signifies the bank's funding cost. So the higher the CASA ratio, it will sort of like loosely translate to lower funding costs for the banks. So that now that they have sort of managed to maintain this level of around 19%, we can see that going further ahead, when the interest rates are not expected to increase further, they should be able to maintain this 19% levels. And it signifies that actually the local banks have managed to maintain their funding cost levels. And I think for them, they have said it as well in their last, all three banks have said in their previous results briefing for the third quarter at least, that they have all sort of improved their funding costs. And I think this is one of the main reasons is because their CASA ratio has stabilized, at least for the last couple of months. And they're also looking in the future that it would probably not move much, and it might actually further increase. So I think that's all I have for the banking sector. I'll now hand it over to Darren for the REITs sector. Thanks.
Yeah, thanks so much, Glenn, for that. Yeah, so let's begin the REIT sector. Yeah, I'll start off with this share price performance. So as you can see, this share price performance chart, the 1 month performance is a blue color bar, while the year-to-date performance is the orange color bar. So basically, in the past 3 months, when the Fed in the September meeting, they came out to say that there was the possibility of having another 25 basis point hike for 2023 is quite high. Then the share prices all crashed, or rather they tanked. And then in November, they came out and said that they came out less hawkish, so rather more dovish on the stance of interest rate policy. And that during the November meeting, we saw a little bit of after the November meeting, we saw a little bit of a share price rebound. And then most recently, which is the December meeting, they came out and said that about the possibility of, as Glenn mentioned earlier just now, that the possibility of rate hikes, or rather rate cuts, is much higher. And they are expecting 25 basis points cuts in 2024, or the second half of 2024. So after the announcement, we saw REITs, because it's a U play, we saw the REITs really rally. As you can see here, the 1 month performance of commercial REITs, and it was outperformer at 10%, while all REITs are positive for the 1 month total return. However, if you take a look at the year-to-date performance, excuse me, the commercial REITs are negative, as well. The best performers or the outperformers for the REIT sector were industrials. Yeah, this was probably because of the strong logistics subsector, where there's a lot of demand coming from the e-commerce logistics and warehousing space. So and third party logistics. So that's why we think the industrial sector will outperform in 2023. But one thing to note that this chart, right, is based on market cap weighted. So like for example, the commercial sector, Keppel REIT takes up a big portion of the weightage in the commercial sector, but inside there is also the US listed REITs, which is the Manulife US REIT, Prime US REIT, Keppel Pacific as well as Elite, but their market caps are very small. And those are the overseas REITs where the share price really crashed. If you put a word to it, yeah, the overseas REITs really tanked the share price. But then because the market cap is so small now, and because this chart is market cap weighted, the Keppel REIT performance really, if Keppel REIT was up 2.3% year to date, and because of that, it really um, brought up the commercial performance. If not, this percentage over here will be way lower. And of course, the US, as you all know, the US office market is really struggling. Now, I will talk a bit about that later. So for this slide, yes, Glenn has it also, but this is just a chart on the Fed rate, which is the gray line, and also the spread of the 10-2 spread as well as the 10-year yield and for both US and Singapore. So as the REITs are really very yield dependent and they're very sensitive to movements in all these 10-year yields. So we keep track of these 10-year yields as you can see towards the end of this month after the Fed came out and said and possibly our rate cuts are quite high next year. The 10-year yields both fell by quite a bit for both the 10-year US as well as the 10-year Singapore government bond yield. So this will really benefit as this is kind of like a proxy to investing in a yield plays. I'll explain more in this chart. So the next chart is actually the 10-year dividend yield spread. So what this means is that the 10-year the dividend yield spread, the dividend yield of S REITs minus the 10-year Singapore government 10-year bond yield. So this what it means is that we are trying to see how much investors are being compensated for investing in the risky asset, which is REITs, as compared to kind of the risk-free rate asset, which is the 10-year bond yield. So it's just like a proxy to it. So as you can see, the red line is the average. So what we want to see is the fact that the graph here, the chart, the line will cross the 10-year, which means that it is more worth it to invest in S REITs now as compared to the 10-year historical average. But right now we see that the S REITs, the yield is actually creeping up. So this means that over time you'll be more you'll be being compensated more for investing in S REITs as compared to the 10-year Singapore government bond yield. But basically the reason why this crept up is because the 10-year yield, as I showed you in the previous chart, the 10-year yield, it all really crashed after the Fed came out with the dovish stance. So the tick up here is basically the fact that the yield is softer. But going forward, we expect this yield spread to increase as well. So meaning when this increases, it'll be more worth it for you to invest in S REITs. We expect it to increase mainly because of the softening of the 10-year bond yields further. Yeah, so the next chart here I have is the S REITs index price to NAV. So this means right now it's trading at 0.86. So what this basically means is that in layman terms, you are paying 0.86 times on a dollar value. So historically, the 10-year average of this is around 1.03. So now we are seeing that the price to NAV is trading at almost minus 2 times standard deviation away from the mean. So this is really extremely cheap if you compare it to historical, and especially during the COVID-19 lows. COVID-19, it was trading at 0.9 times, but now it's trading at 0.86 times, which means it's really trading at very cheap valuations in comparison. So we think it's a good time now to start entering the S REITs. So we have overweight call. So the next chart is another reason why we also like we think it's the right time to enter in the S REITs now. So this chart is the forward dividend yield. Basically, it means what the analyst or the consensus forecast of the dividends divided by the current share price. So as you can see in the chart here, it's trading at above the historical 10-year average. So what this means now is that if you invest in S REITs now, you're getting more dividend yield as compared to what you would have gotten on average in the past 10 years. And we expect this to perhaps go up a little further as well. Yeah, because we think that the share price, the rebound was really the sentiment was too good already after the Fed, so it might retrace a little bit, but going forward we still think this is forward dividend yield is, yeah, we will continue trending upwards as well. But at a slower pace because it's already almost at it's at 0.5 around 0.5 times standard deviations above the mean. Yep. So in this chart I have here is more of the individuals price to book versus the dividend yield. So as you can see here are some of the bigger individual REITs, and these individual REITs here we have that we see that they're clustered around the slightly under 1 times and around the 5 to 8% dividend yield. So it's basically around here. Not sure you can see my mouse, but it's around here. So these are a lot of the REITs with Singapore listed assets. They are trading around the middle part here. But towards the right side, you see. So how you see this chart is if you are trading towards the right side, you're trading very cheap, because that means that you're trading at a very low price to NAV and you're trading at a very high dividend yield. So an example is Prime US REIT, which you see at the bottom right. And if you're trading at towards the top left hand corner, it means that you're trading at it's rather expensive for it, because you are trading at a high price to book and you're trading at a lower, and the REITs are trading at a lower dividend yield. So for this, we can see that a lot of the REITs with overseas assets like Elite, Cromwell, Capital Pacific O, and Prime US REIT are trading at extremely cheap valuations, like under 0.5 times price to NAV, and for Prime it's trading at about 30% dividend yield. Yeah, so this is because for Prime and Capital Pacific O, the US market is very weak right now, and then they're following, and we all know their peer REIT, which is Manulife US REIT. It's not in this chart here because Manulife US REIT, they halted their dividend payments. So it basically, I took it out from this chart. So for those of you who do not know, Manulife US REIT, they breached their unencumbered gearing ratio of 60%. So because of that, the lenders or their lenders, they had the right to recall all their loans. So all their loans were forced to be, not say forced to be paid, but all their loans were classified as current. So because of that, they also breached, because of the gearing breach, they came out, and recently they came out with a restructuring plan. So the restructuring plan, it has a few layers to it. So the first layer is they are taking a sponsor loan. The next layer, they'll be divesting some assets to pay off some of the current loans. And the next layer after that is they will have a disposition mandate to divest further assets to help them to par down the gearing. So right now, the US office market is really in not good shape, especially the downtown, especially the Los Angeles, all these places. Yeah, mainly because of high crime rates, and especially high tax rates as well. So a lot of all these companies are moving out to, or rather the red states, they're moving to red states because there are lower crime rates there and the tax rates are lower. Yeah, so all these gateway cities, rather you call it, like Manulife have a lot of assets in the gateway cities. So this the weakest market in the US is rather bifurcation. There are two types. So one type is a very weak US market, which is in the gateway cities, and the Sunbelt cities are the stronger assets. So yeah, those are having a better performance. like Keppel Pacific Oak and Prime, they have some assets there. So yeah, those are performing better. Yeah. So I'll move on. Okay, so how are REITs affected by the higher interest rates? So this is a perfect example here. So this is the first half of 23, the financial results of some of the REITs. I just took a snapshot from this. As we all know, the Fed started raising rates in early 2022. So in this is basically the year-on-year performance or year-on-year change in NPI, which is net property income, and finance costs and distributions per unit. So because of the higher interest rates, we also saw that the finance costs for all these REITs listed here, we see for CapitaLand, Escort Trust, the dividends, or rather the finance costs, the finance cost, it rose by 33%. And for Capital DC, the finance cost year on year, for the first half, it rose by 73.4%. So this chart shows that you need to grow your NPI by a lot more in order to offset the rising finance cost in order to maintain a stable DPU. And from this chart, we can see that the only asset class, right, that can really generate a growth in DPU year on year or going into 2024 would probably be hospitality, mainly because of the strong increase in NPI, like the net property income, can really offset the higher finance costs, and as a result, they can grow their DPU as we see in the first half change. 19% growth in DPU for CapitaLand Escort Trust. But you see a decline in the other REITs here. Like for example, for CICT, CapitaLand Integrated Commercial Trust, the NPI rose by 10%, but as a result of high finance costs, the DPU only grew by 1.5%. And same thing for Capital DC. And the biggest hit is Prime US REIT. Because of the weaker operating performance as well as the higher finance costs, you see that the DPU really dropped by 30%. But that is also, there are some other factors in there as well, because Prime US REIT, they decided to pay their management fees 100% in cash, so that affected DPU payment as well. For Keppel REIT, you see NPI drop slightly, and with the higher finance cost, their DPU is down 2.4%. But this, if you include, because this DPU of minus 2.4%, it includes a 10-year distribution anniversary distribution. So if you exclude that, the DPU will be down by about 10% if you include that. Not say one off, they have it for the next few quarters, but if you exclude the anniversary distribution, the DPU will be down more. So I'll move on to the next slide where it explains that we favor the hospitality subsector because mainly, like I mentioned before, for the DPU growth, it's the only subsector we think that can really generate a solid DPU growth year on year, as the increase in revenue can offset the higher finance cost, which is affecting the whole global markets. So this chart is the hotel RevPAR and visitor arrivals. So for RevPAR, it means a revenue per available room, which basically means your average daily room rates of your hotel times the occupancy rate. So a higher RevPAR is definitely better for the REITs. So as you can see in the blue line, the hotel RevPAR has been growing, and since COVID, it's been growing year on year, and it dipped slightly mainly because of seasonality, but we expect it to creep up going to the December holidays. And for the visitor arrivals, we also see it increasing year on year, but it's also down mainly due to seasonality. Yeah, but year on year, as you can see, I have the figures down there. Like it's up 35%, 34.7% for November 2022 and 2023. And however, for October, we see that the average daily room rates, it dips slightly, and the hotel occupancy also dips slightly for RevPAR. But this is mainly because in Singapore we have this huge global event, which is the F1, the Formula One Singapore Grand Prix. It happened in September in 2022. My apologies. It happened in September in 2023, which is and this F1, it happened in October in 2022. So from this chart, you can see that basically during October 2022, the hotel RevPAR was much higher as compared to October 23 because in 23 there was the absence of the F1. So that really played a factor in the declining RevPAR for year on year. But other than that, other than this abnormally, we expect that the RevPAR to continue growing. And right now, we see that the average daily room rates, they are already at above pre-COVID levels. So the room to grow for this RevPAR is, or rather the average daily room rate is much lesser as compared to last year, where there was a lower base and the average room rates could really be boosted up. But right now, for RevPAR, the growth going forward will be definitely from occupancy rather than average daily room rates. And because of already the high average daily room rates that we see here. Yeah, and all these average daily room rates we see in the past year, a lot of it are at all-time highs. Yeah. So the other sector that we favor, other than hospitality, is retail, because we think that this sector will be resilient, and it's a sector that basically the leases, they can generate positive rental reversions going forward. So for suburban retail malls, they really benefited from the work from home phenomena. Like a lot of in companies, they got their employees to work from home. A lot of these employees, they go to their suburban malls, like where near their houses, to buy food and etc., and go there to spend on consumer staples. So because of all these factors, the suburban malls, they really performed very well during COVID. While the downtown malls, we saw very little international visitor arrivals, and usually downtown malls, they are higher like luxury products, where a lot of the spending is done by Chinese tourism, or rather Chinese tourists. And we see that Chinese tourists, they are coming back to Singapore, but at a much slower pace than anticipated. So because of this, the potential for growth for the Chinese to return next year will be much higher. And when tenants, they negotiate for rents with the landlord, usually they look at the potential for tenant sales going forward as well, and as well as a lot of other factors. But this is a factor that is part of the negotiations when we expect the return of Chinese travelers to be much stronger next year. So basically the landlords, they can negotiate a higher rent, and as a result, they will get higher rental collections from these leases, and that will benefit their revenue line. So that's for downtown malls. And suburban malls, we expect it to continue to remain very stable as we see tenant sales are increasing. And we see for this particular month, the retail sales index for ex-motor vehicles is down 1%, but this is the first decline in many years, as you can see in the chart on top. First decline since late 2021. Yeah, and this retail sales index, we expect it to improve, or rather not decline so like 1%. We expect to improve mainly because there's this government payout, that government assurance package that will possibly lift retail sales. Yeah, so as well as next year, there's the GST hike of 1%. So we expect that a lot of people will start to spend before the GST hike, because they don't want to avoid paying that 1%, right? So in December, we expect that the retail sales to probably be quite good. Yeah, and one more thing that's affecting this retail subsector is that there's very little supply coming into the market. So all this will bode well for when tenants negotiate their rents, when landlords negotiate their rents with the tenants. So we expect positive rental reversions going forward for both downtown malls as well as suburban malls. And suburban malls, especially since they've proven their resilience through COVID-19. Yeah, so I'll now move on to the stock picks. I'll hand over the time to Glenn.
Hey, thanks, Darren. Yeah, so for the stock picks, I'll just be going through the three local banks, DBS, UOB, OCBC, as well as adding in SGX as well. So for starters, I'll just start with DBS. We look at DBS, I'll jump all through the line items, maybe just go straight to the positives and the negatives as well as outlook. For the positives, there are three main positives. First one being, as what I mentioned earlier, about the net interest margins and net interest income. So both has continued to increase year on year, and this is so for all the results we're looking at the third quarter. So it has continued to show very good growth in the third quarter year on year, and this is mainly due to the interest rates being high. But however, this was slightly offset by the loans growth actually dipping 2% year on year. And just to note that the loans, the DBS was they benefited quite a bit from the Citi Taiwan consolidation, which contributed around 10 billion Sing dollars to their loans. The second positive being that their fee income has continued to grow, and they did expect and guide for this recovery for the rest of the year because they were coming off this very low base in 2022. So it grew mainly from broad-based growth from their wealth management fees and their card fees, loan-related fees. So I would say their card fees also from the higher spending from the post-COVID recovery and the revenge travel spending, as well as the integration of Citi Taiwan. So this added quite a bit to their credit card fees. And the third positive would be that their other non-interest income, which consists mainly of their trading income as well as treasury customer sales, also rose. So for the negatives, two main negatives. First negative was that their allowances rose 21% year on year. And this was mainly due to the higher specific provisions in the third quarter. And this also resulted in the higher credit cost of 18 basis points for the third quarter. So this rise in specific provisions was mainly due to the allowances which were prudently taken for the exposures linked to the recent money laundering case that happened in Singapore. I think most of us are aware of that money laundering case. It was very big. It was around a couple of $1 billion. So what they mentioned was that they did actually sort of provision fully for the full exposure. So they're not expecting to get anything back from the case from the loans that were linked to, or the collateral that was linked to this money laundering case. So they really provisioned fully for that. But it didn't really, it did increase their credit cost, but it's still quite good with the 9 month. We're looking at the FY23 9-month credit cost only at around 11 basis points. The second negative would be that their CASA ratio has continued to decline, but we're looking at a year-on-year decline. So it fell 12.5 percentage points to around 47.8%. And this was mainly due to the continued move towards the fixed deposits from the high interest rate environment. But if you look at their total customer deposits, it was actually flat year on year at around 531 billion, because most of this CASA that was moving out, the funds that were moving out of the current account savings accounts were actually just going into fixed deposits. So it's still maintained with DBS. As for the outlook, we do feel that their business momentum is continued to be strong, and they have said also that the stress tests of their vulnerable sectors as well as countries have revealed no imminent areas of concern. Their GP reserves are also very sufficient, and it's their capital position as well as liquidity is well above the regulatory requirements, and they also have very high allowance reserves. As such, you can see that their CET1 ratio has risen by 0.3 percentage points quarter on quarter to 14.1%, which is still at the upper end of DBS's target operating range of 12.5% to 13.5%. Now, I'll also speak briefly about their dividends. Their third quarter dividend per share was raised 14% year on year to 48 cents, bringing their 9-month total dividend to 138 cents. So we do expect that in the next quarter, in the fourth quarter, their dividends should be similar quarter on quarter at 48 cents. So this will bring their total dividends to 186 cents for FY23. And the third point for the outlook would be the fee income recovery. So with China's recent reopening as well as the recovery of most of the countries, the management does expect that it will benefit the regional operating environment, and they have also seen an uptick in momentum and business volumes. There's also further upside from credit cards fees from higher spending due to the ongoing recovery in travel as well as continued momentum expected in the wealth management. So they did guide for double-digit fee income growth for FY24. So this is for the next year. And this will be mainly sustained by wealth management as well as credit card fees. Now, for the last point of the outlook, which is their net interest income as well as their PATMI guidance, they have not really changed their FY23 guidance. So we should sort of expect that FY23 will finish off this quite similar to the third quarter. But they did provide some FY24 guidance, and they did say that their net interest income will remain at the same levels as FY23. So the higher for longer interest rates will continue to support their net interest margins, but this will be offset by lower loans growth. And with the chance for rate cuts in second half of 24, the loans growth should pick up slightly, but with NIMs being slightly more stagnant. And this will result in a sort of a net where their net interest income is relatively similar. But I think surprisingly, they also did say that there was another 105 billion Sing dollars of fixed rate loans, which will be repriced in FY24. And that means that they might be able to further increase their net interest margins as these fixed rate loans get repriced to a higher rate, and this is beneficial for DBS. So for total allowances, it's expected to normalize at around 17 to 20 basis points of loans, and their general provisions overlays will also be released if the specific provisions are higher than expected. So as such, they have guided for the PATMI or earnings to be maintained at the current levels in FY23. So we do have a target price of $41.60 for DBS. Now moving on to my next stock. Yeah, so my next topic will be UOB. So for UOB, if you look at it, it's roughly relatively similar. So for the positives, and the first positive also similar, is that their net interest income and net interest margins have also continued to grow. But I think it's slightly different. So their loans growth also decline was similar at 2%, a drop of 2%. But their net interest margins actually declined 3 basis points. So while it did rise 14 basis points year on year, but it declined 3 basis points quarter on quarter, mainly due to the lower margin on excess liquidity. So for the second positive is that their fee income has actually recovered much faster than DBS, and it recovered to near an all-time high. And this was mainly due to higher credit card fees, which hit a new record of 104 million. So this credit card fees, which they have really spoke quite a bit about, was mainly due to the partnerships that they had with all the concerts that has been going on that will be going on in Singapore. So concerts with the big artists like Taylor Swift, Ed Sheeran, Coldplay. So they partnered with all these artists, and there's a very they managed to capture quite a bit of income from these the ticket sales. And they also said that while the initial boost in ticket sales it looks good, right, on paper. It shows that they are growing something, but it's only a one-off. So what they are trying to grow is the customer base by retaining these customers who have signed up with UOB, maybe a current account or even a credit card. And so the main goal is not really just to capture that first initial sale, but it would be how to maintain that customer and to make them a UOB customer moving into the future. And for the fee income, there was also broad-based growth from their wealth management fees as well as their loan-related fees. So the third positive would be that their NPAs or non-performing assets fell 27% quarter on quarter as their asset quality stabilized during the quarter. For the negatives, the first negative would be that their other non-interest income growth was quite flat year on year and actually declined quarter on quarter. And this was mainly due to their trading and liquidity management, mainly due to their growth in their customer-related treasury income was more than offset by lower valuation on investments due to market volatility. For the second negative would be that their credit costs rose due to higher specific provisions, despite general provisions right back. So this is a different reason why the specific provisions increased for DBS. So for UOB, they said that the increase in the specific provisions was actually more of an preemptive move to rebalance the collateral in US and Hong Kong, China. So they did say that these accounts were actually not distressed or non-performing, so they were paying their interest on time, and it was very these are accounts that are doing well, but they did increase it just to be prudent and to be preemptive. So the last negative would be that their expenses was up 4% year on year, and the increase was across the board. So to retain staff, so the increased staff costs, there was also revenue related as well as IT related expenses. But nonetheless, if you look at their cost to income ratio, it did improve 1.6 percentage points year on year, mainly on the back of strong income growth. As for the outlook, their UOB's profit should continue to grow into the rest of 2023 on the back of stabilizing margins, stronger fees, as well as lower provisions. And we do expect that this will continue to grow into FY24 as well. For the fee income, they did say that they expect their fee income similar to DBS, where they will recover from this very low base in FY22. But the difference being that their growth will be led by credit card fees, as well as their fund and wealth and fund management fees as the market sentiment recovers. For the loans growth, the management does expect to see strong demand for loans as the cross-border activities pick up, and the ASEAN loans growth is also expected to be higher, but with some slowdown in Singapore and North Asia. They did say also that they have guided for this mid-single-digit loans growth for FY24, which is quite a big improvement compared to FY23, where we're actually seeing it will probably end with either a flat or a negative loans growth in FY23. So we do have a target price of $35.90 with a buy call for UOB. Now moving on to my last bank counter, which will be OCBC. So for OCBC, the positives, okay, also similar. If you look at the first positive, it will be the net interest income has increased. I don't think I will really say much about this. So it's quite similar. It's mainly due to the high interest rates. But the difference is that their loans growth was actually flat. So this might have benefited their net interest margins a bit more than compared to DBS and UOB. The second positive would be that their insurance income was up 26% year on year. And this was mainly attributable to improved investment performance, as well as the adoption of the new SFRS 17 reporting standard. For the negatives, sorry, I think this might be the wrong slide. Yeah, so just ignore the words there. So for the negative, the fee income declined year on year. Oh, wait, sorry. Give me a minute. Yeah, so for the negative, the allowances was up 19% year on year with credit costs. Hey, sorry, give me a minute. I think I opened the wrong slide here for my side. Okay, yeah. So for the negatives, the main negative was that their allowances was up 19% year on year. And this was mainly due to, again, the specific provisions growing. And this was from corporate accounts in various sectors and geographies all over ASEAN, and not to any specific account. So OCBC did not really mention the reason for why there was this increase in specific provision. So unlike with DBS and UOB, they did not really mention why, but they did say that there was not, or they did not see any systemic risk with the corporate accounts that they have increased the specific provisions for. So this did drive up their credit cost by 4 basis points year on year to 17 basis points. And the last negative would be similar to DBS, where their current account savings accounts ratio fell 9.8 percentage points year on year. But we also saw that their customer deposits rose 5% year on year, mainly due to the shift in current account savings accounts to their fixed deposits. As for the outlook, the loans growth has declined in the third quarter, and this is falling below their guidance for FY23, and they have sort of guided for a low single-digit loans growth for FY23. And for the fee income, with the reopening of China, they are positive on the broader outlook, and they also do expect the reopening to support the China-Southeast Asia trade and investment flows. So we do have a buy call for OCBC with an unchanged target price of $14.96. And for OCBC, it's our preferred pick among the 3 local banks, mainly due to the attractive valuations and the dividend yield, the highest dividend yield among the 3 banks of 6.6%. And it's also buffered by a very well capitalized 14.8% CET1. And they also have a further fee income recovery from China's reopening. I will speak more about OCBC in my next slide. Yeah, so as I mentioned, OCBC is our preferred pick among the three banks. And if you look at their CET1, so their CET1 here is in the blue bar. It's still the highest amongst the three local banks uh, at around 14.8%. So even with their recent acquisition of the Indonesian company, they only spent around like less than 200 million Singapore dollars. Their CET1 it will still be maintained at this sort of really, really high levels. And their optimal range would be around 12.5 to 13.5%. So what we do expect is that they will need to spend this money somewhere. They have done it with the recent acquisition in Indonesia, but I would say that the other way that they can spend this capital would be to increase dividends further. So they have not really said much. The analysts have all tried to ask the management, but they did not want to say. But I guess that's the only option left for them, which is to increase dividends further. And currently, the dividends are also the highest amongst dividend yield at least, are the highest amongst the three local banks at 6.6%. Now, moving on to my next slide for SGX. Yep, so for SGX, I think I'm running short of time, but I'll just very briefly cover. For SGX, the main positives would be that their treasury income has surged to record levels. So I'll speak more about their treasury income in my next slide where I put a graph. So for the second positive would be that they have continued to get higher fees from their FTSE China A50 as well as their Nifty 50 contracts, and we do see that this has benefited them, as the higher fees is giving them a better margin. And their FICC currency and commodities also has continued to grow. However, for their negatives, the first negative is that the listing revenue has continued to dip. So we have seen in the first half that their listing revenue was actually quite low, and it has continued into the second half of 23, which for the whole of FY23, I guess it's sort to be expected that their listing revenue was extremely low. So this put a dent in their revenue quite a bit. Their DCI, or data connectivity and indices business, was also flat in FY23. So we do have a buy call and target price of $11.71 for SGX. For the outlook, I'll go to my next slide. Yep. So I'll speak more about SGX and how they benefit from the rising interest rates. So I guess not really known to many would be that SGX has this huge collateral balance where the customers put in the money and they have to maintain this sort of balance with them. I think they have a really huge amount, which is around I think it's I think 140 billion. So they have this money stored with them, and what they do is that they will put this money into multiple fixed deposits and sort of all over in multiple different currencies as well, and they earn that interest income. So this falls under the interest income category for SGX. And what happens is that when the interest rates are very low, when they put it in the fixed deposit, they can't really earn much interest from that. So we can see that in the blue bar, which is the actual treasury income, you can see that it lags behind the Fed funds rates because they put it at like in short to medium term fixed deposit, so it's lagging. So you can see in 2022, it was really low because the interest rates were very low. But you look at 2023, it suddenly bumped up because of the higher interest rates. And for FY23, they actually had a 300% rise in close to 300% increase in their treasury income. So this added close to around 90 million to their bottom line. Yep, and going forward into the future where we see that interest rates will continue to be high, this will continue to further increase for SGX, as we see that they will put into they will place back the funds back into higher interest fixed deposits. Yep, so that's all I have for my stock picks. I'll now hand it over to Darren for his stock picks. Thanks.
Yeah, thanks, Glenn. Yeah, I'll just run through my stock picks a quick one. We try to leave a bit of time for Q&A. Yeah, so for my stock pick, the first one under the hospitality subsector that I mentioned that we favor is CapitaLand Escort Trust. So this is just the quarter business update, but I'll skip most of it. So basically, we still like it because we believe the portfolio RevPAR will continue to improve. As you can see, there's a chart in the center there. The portfolio RevPAR since COVID, it has really recovered slowly, gradually rather, and it has almost reached the pre-COVID of fourth quarter 19. We expect it to actually surpass that level in the fourth quarter when we see the full year results. And there's a table on the left, so that shows the year-on-year performance. The RevPAR, we saw Japan open up, so to international visitors. So yeah, we saw 198% year-on-year for that. But the other countries, they opened up fairly earlier in 2022, so the year-on-year performance is not as high, not as drastic as in Japan. Yeah, we like Ascott. Another reason we like them is because they have resilience from their stable income sources. So they have one part of their base is from master leases, where that's considered and rather stable, the master leases as well as the management contracts with minimum guaranteed income, and they'll get the upside from the management contracts, like the recovery from the growth in RevPAR and recovery in travel from the management contracts. So there's this growth component and a stable component that we both like. So for Ascott also, they have a proactive capital management, and the cost of debt is very low at 2.4. That's much lower as compared to a lot of their peers. And their gearing is also very safe at 35%. So for the outlook, we expect the RevPAR will continue growing because we see forward bookings are still very healthy for the fourth quarter, and we expect it to continue growing forward. And we also expect international visitor arrivals to pick up as the airline capacity increases. So currently, international visitor arrivals is being capped because the airline capacity is not back to pre-COVID levels yet. So when this airline capacity starts to pick up, we expect more visitor arrivals as well. And for Ascott, they've been doing a lot of divestments and acquisitions. So the most recent acquisition that they announced is the Cavendish London. So when they acquire this, just a quick one, they will be closed for renovations in the fourth quarter of 2024 and to fourth quarter 2025, and they'll be using some divestment gains that they have in their books. So currently they have about 200 million in divestment gains that they've yet to pay out. So, but one thing to note is that because they did an equity fundraising just in the third quarter, because they did that, we adjust out some of our numbers in the model, and as a result, our DDM, our dividend discount model target price was affected and was lowered from 120 to $1.04. So Ascott is rather stable as it pays a dividend yield of 6.3%. So my next counter here is Fraser Centrepoint Trust under the retail subsector that we also favor, mainly because for FCT, there are full suburban mall portfolio with one office asset, but the office asset is very small. So the good thing about them is that their portfolio occupancy is nearly full at 99.7%. So that is really as full as you can get. So they also have positive rental reversions for the full year FY23, and we expect it to continue going forward. Their tenant sales and shopper traffic continues to improve and will probably improve even further as visitor arrivals start to pick up. Their retail portfolio valuation also increased because their assets are all in Singapore, and we see that the portfolio valuations for Singapore assets are rather stable, but because of the high interest rates, there's some cap rate expansions in overseas assets. So a lot of overseas assets are expecting some valuations decline, but because Singapore is rather limited by space as well, and the limited supply is part of the reasons why we see that for Singapore assets, especially retail, we see the portfolio valuations are very stable as compared to other assets like the US office, for example, where we expect further declines in valuations. And the good thing about FCT is that they do not have any refinancing risk in FY24, which is next year, and they have only 63% cost of their debt on hedge rate, so they will benefit from any Fed interest rate cuts next year. Yep. Yeah. So one thing to see, one metric that we take a look at for FCT is occupancy cost, which is the amount that rent that tenants pay over the total retail sales, or rather the tenant sales. So right now the occupancy cost is low at 15.6%. It averages about 17 to 18% in the past. So right now, basically, take a look at it, is you're paying lesser rent over in comparison to historical based on your tenant sales. So the amount of rent you pay divided by tenant sales is only 15.6%, which is lower than 17%, which is the average. And it went up all the way to about 20% during COVID. So now this low occupancy cost will support rental reversions negotiations going forward. And for FCT, they also we'll have some inorganic growth opportunities coming from some more acquisitions from Next and North Point City Southwind. So right now, FCT, they have a target price. We have a target price of 229 and a dividend yield of 5.5%. So FCTs, they have a focus on essential services, which I like, which we like rather, and which is very resilient even in a COVID slowdown. And the last call that we have is on Prime US REIT. It's in the US market, which is struggling right now, but because of very cheap valuations, it's trading at 0.25 times price to NAV, and is trading at a very high dividend yield of 25%. So this Prime US REIT is for higher risk takers, or rather, the not so the more risk averse. I would recommend you not invest in this because of a high volatility in the share price of this Prime US REIT. Yeah, but we expect that the US office to meaningfully recover in FY25. Yeah, so sorry, I'll just skip this because of shortage of time. We'll try to leave some time to Q&A, and I'll hand over the time to Jay. Yeah,
Hi, Darren and
yeah,
Glenn.
thanks.
Thanks so much for sharing the ideas and all the stock ideas as well. But I see there's quite some questions on the Q&A. Maybe let's have a look on the some as I'm scrolling through the question that I would like to answer. Maybe we can have a look which kind of question you are gonna answer. Maybe I'll start with one. I think this one is more directed to Glenn. So with the widespread of money market funds being a better alternative than traditional saving accounts and current accounts, what do you think the banks in Singapore are facing great pressure on that?
Yeah, this is quite a good question. I would think when you say being a better alternative, it's really quite subjective. You know, money market fund, it's not guaranteed, so it's not capital guarantee either. So, you know, yeah, when the market is doing good, of course, you know, you see the interest, the yield is really good. I would say I don't think the banks have really much fear from the money market funds. And I would think other things like the fixed deposits. So not just the banks are providing this kind of like capital guaranteed returns. You know, many other companies are coming up with all this. So, you know, that would be the say better alternative, right, to the traditional savings and current account. So the banks in Singapore, they don't really face great pressure from this because, you know, they also have their own products, right? They do have their own team of people working on this as well. So what they most likely would do is that they would, if a customer is like wanting to pull out money and say that, you know, it's not good, the current, you know, the savings account is giving such low rates, they'll say, okay, how about you go with our fixed deposits instead, you know, which they do have, or they will go into other products even. And that's what the bank can provide, right? They have a wide range of products where it's not just their current account, savings account. But as we all know, you know, everyone does have to have this current account, savings accounts. And if you're gonna put in your salary every month, why don't you just leave a good portion of it inside, if you are at least a salary worker, where you can get the higher rates. So it might not be fantastic, but at least you're getting something, and you still need to have a spending account as well.
As for the next one, I think this is for both of you. So how do you foresee the impact of the global economics on Singapore's banking industry, banking sector? And with the sudden rise of COVID cases in Singapore and Malaysia, what do you think the impact is on both the industry?
Okay, I think it's mainly for me again. So for the banking sector, I would say we are quite sheltered in Singapore because, you know, we focus mainly on the local market as well as in ASEAN. So what's happening overseas, let's say, you know, even in the Hamas and, you know, in the US and all over the world, it doesn't really affect Singapore as much. So we are quite sheltered. We're lucky for that. So the banks have been able to benefit from this as well. You can see from their bottom line, all three banks are performing well. And as for the COVID cases, I think it's really I would say it's quite seasonal. I'm not very sure. I'm not a doctor, but there has been a recent before this rise in COVID cases, it has risen before, and you know, we had, at least in Singapore, we had to sort of like close up everything again. So it's nothing new, I guess, for Singapore, but I think the thing that will be affected, at least for the banking sector in Singapore, would be maybe if there really are sort of COVID regulations coming back, then this might affect that their fee income, because their credit card fees are very dependent on this post-COVID recovery, and this is the holiday season, so people might not go out as much. So I'm just saying these are really a lot of speculation. Yeah, but that might be one of the impacts to the banking industry.
All right. And Darren, this one I think is for you. Can you provide insights into the current supply and demand dynamics within the Singapore real estate, and how they may influence the REIT in the upcoming 2024?
Yeah, sure. So in general, in Singapore, of course, we are limited by space. So the supply is rather not not a lot. And the demand for Singapore, because as I mentioned, we are limited for space, so there is demand coming. But it differs for many of the subsectors. But the biggest one, I would say, I'll just go into the office sector, for example. So for the office sector, there's a lot of contrary to the fact that there's no very little supply coming on, like for the retail sector. There are a lot of the supply is not a lot for downtown and suburban malls, but for the office sector, there's two main office big projects that are coming up in 2024, which is IOI Central Boulevard Towers with over 1 million square foot and 600,000 square foot for Keppel South Central. So these two are big supply that's going to come into the market. And because of that, we don't think that the demand can really absorb this supply coming in. That's one of the reasons why we are not so positive on the office sector as well. Like I wanted to mention in the slides as well, but I just slipped my mind, and due to shortage of time, I also didn't mention it. But since there's a question here, yeah. So for office, basically, we think rents have peaked at 1185. So in the third quarter 23, which is just the previous quarter, office rents peaked, or rather not peaked, is at 1185. It grew by 5 cents over the past 2 quarters. But we think it will start to plateau going forward because of the supply that's incoming, like I mentioned earlier. So for that, we see office supply, the demand supply dynamics not in the favor of office especially. Yeah. I
And
think,
this one is my own personal question, actually. So
yeah, sure.
previously, I mean, during the COVID season, WeWork is kind of like the co-working space that everyone's
Yes.
into. And then with the WeWork going into bankruptcy, do you think anything investors or have any impact on the Singapore REITs, or is there any consideration investors should bear in mind about?
Yeah, sure. So WeWork, as you all know, they filed for Chapter 11 bankruptcy, but this mainly affects their US properties and US assets. So, like I mentioned for Prime US REIT, they do not have any US co-living, or sorry, not co-living, co-working space exposure, and they do not have any exposure to WeWork. They used to have it 3 years back, but they do not have it anymore. And more for Singapore, in Singapore, like Capital Land Integrated Commercial Trust, they have WeWork as one of their top tenants. But for CICT and in this part of the region, in like Singapore, WeWork is still they're not having any troubles here in Singapore in this region. So we are still seeing WeWork pay their rents and they're not in arrears. So yeah, but of course we are monitoring if in a case where WeWork were to vacate like CICT asset, for example, then we believe there might be some downtime, but it's possible for them to backfill it, the space. Yeah. But generally, WeWork's Singapore's business is not really impacted. The business that's impacted is more for the US side. Yeah. So as of now, no impact to Singapore assets. Yeah.
Because that's one of the quite big issue that I ran to on the news back then. However, we still have time for one more question, one or two questions. Maybe Darren and Glenn, is there any particular question you all would like to answer?
Maybe I'll just take this one. It's very straightforward now, I guess. Okay, there are two questions. Two people have asked the same thing. Mainly, I'll just pick one of them first. It says the interest rates next year, interest rates are going to be cut. So is it not good for the banks? I think another one also asked a similar question. So as I mentioned, maybe I didn't really say it very specifically, but when the interest rates are interest rates is really a double-edged sword for the banks. So interest rates high, yeah, it is good because they earn a higher net interest margins. But what we have seen so far is that loans growth has taken a dip, so it has declined. So so while interest rates are good for the banks on one hand because of the net interest margins, but on the other hand, when we see that the loans growth has dipped and it has not doesn't look like it's going to be picking back up anytime soon. So on the flip side, when interest rates are going down, yes, the net interest margins may not be as high, as compared to now, but loans growth should start to pick back up. So this is a balancing act for the banks. And I think the most important thing for them would be the funding cost. So this is why I have a slide on the funding cost with the CASA. And they have managed to maintain the levels. For the past almost a year, it has declined, but now they have continued to see it being maintained. And they're also being able to hold the funds. So what one of the banks did say, the main reason why they have so aggressively increased fixed deposit rates while they do not earn much is because they want to maintain sort of retain this customer with them, so that when the interest rates start to go back down again, then they can sell back to the customer many different products. So as long as the customer has the money with them, they are able to sell to their customer. And I think that's the main point. So when interest rates are up, they have to do their best to maintain their customer, which we have seen with all their deposits still even increasing actually in this kind of high interest rate environment. It's not going out of the banks. And when the interest rates start to go down, then they will transition that money into other ways to earn money. And one of the other ways to do that is the fee income, which is why a lot of them are pushing this fee income recovery. And I think one more point also is that they do realize that whatever they have now currently, it's a bit oversaturated. So in Singapore market, not just Singapore, I guess, even in whatever market that they are, it's quite saturated. So you have seen all three banks now, even OCBC was the last to do so. They have done a lot of acquisitions with both the City acquisitions for DBS and UOB, and OCBC currently with their very recent acquisition. So they do realize that maybe it's not enough just to hold it with whatever we have. They have to grow, and they are doing so by both doing it by growing their acquisitions and also digitally. So all three banks are trying to push their digital initiatives. I think there was another question about digital and technology. Yeah, so I think all three banks are trying to really put in a lot of effort into improving not just their apps, but also their core systems, and trying to make it better for the customers and to attract especially the younger generation going into the workforce.
All right. I guess it's a wrap today. Thank you so much, Darren and Glenn, for sharing it with us on the REITs and the banking industry on Singapore. And see you all next week. Thank you.
Thank you
Thanks.
so much. Thank you. Bye bye.